The screen glows with a harsh, flickering light. The TSMC ticker is flashing red, a steady, rhythmic pulse that matches the spike in your heart rate. You bought at the peak, convinced that the world's leading semiconductor giant was a one-way ticket to wealth. Now, the numbers are sliding downward. 5% gone, then 6%. The panic sets in, a cold tightening in your chest as you watch your capital evaporate in real time. You are not alone in this, but that offers no comfort. You are currently being harvested. The market is not a neutral machine. It is a system designed to extract liquidity from those who act on impulse. You thought you were an investor, but the red numbers prove you are merely the fuel for someone else's profit. Every time you refresh the page, hoping for a bounce, you are feeding the very volatility that is draining your account. It is time to stop watching the ticker and start understanding why you are losing. The first trap is the volatility blind spot. You started your recurring investment when the news was loud and the sentiment was euphoric. You treated the stock like a savings account, expecting a straight line upward, month after month. When the first 10% correction hit, you did not see a discount or a standard market fluctuation. You saw a disaster. You watched the price drop and assumed the asset itself had failed, rather than recognizing that price movement is the primary function of any liquid market. You lack the mental framework to view volatility as a feature of the market rather than a bug. Because you expect the line to only go up, every dip triggers a fight-or-flight response. You are not analyzing the company. You are reacting to the noise. You are measuring your success by the daily chart, a short-term metric that ignores the underlying reality of the business. By failing to distinguish between temporary price variance and permanent loss of value, you have blinded yourself to the mechanics of the market. You are looking at the screen, but you are not seeing the market. You are chasing trends without a helmet. Every time you jump into a stock because the news is loud, you are betting on momentum rather than value. You treat the market like a sprint, ignoring the fact that the business cycle moves at its own pace, indifferent to your desire for quick returns. When you ignore the cycle, you lose the ability to distinguish between a temporary dip and a structural shift. You see the price falling and you panic because you have no protection, no strategy, and no understanding of the cycle you are trying to ride. You are exposed to the full force of market volatility because you refuse to prepare for the inevitable downturns. You are not investing. You are gambling on the hope that the trend will continue forever. But trends do not last. They break. And when they break, the investors who are not wearing a helmet are the first to be wiped out. You need to stop looking at the daily chart and start looking at the business cycle. If you ignore that reality, the market will force you to face it, usually at the worst possible time for your portfolio. The second trap is capital mismanagement. You poured too much of your net worth into a single ticker and now you are paying the price. When your financial survival is tied to the performance of one company, your biology will always override your logic. You are no longer making decisions based on data. You are making decisions based on the immediate, visceral need to stop the pain. This is the point where the investor disappears and the panicked survivor takes over. You stare at the red ticker, and your heart rate spikes. You gave up after 3 months because the results were not immediate, and the pressure of having too much capital became unbearable. You are not thinking in years. You are thinking in minutes. By concentrating your risk, you have turned your portfolio into a trigger. You cannot make rational financial moves when your body is screaming for you to exit. You are forced to choose between sanity and strategy. This is not investing. This is a biological trap designed to force you into selling at the bottom. Real wealth is not built in a single quarter. It is forged over years of consistent, disciplined action. If you find yourself checking the price every hour, you have already lost the battle against your own impatience. You are not building a portfolio. You are waiting for a lottery ticket to pay out. If you cannot sustain your buys during a 2-year bear market, you are not doing recurring investment. You are just gambling in slow motion with your life savings. Think about that. 2 years of red, 2 years of stagnation. Most people fold in the first 6 months because they lack the conviction to hold through the grind. But the market is not a casino. It is a machine that transfers wealth from the impatient to the patient. Stop the cycle of panic. Stop the gambling. Start building a foundation that can survive the long, cold winter of a bear market. The third trap is the single-point combat mindset. You stare at TSMC and let its price dictate your happiness. This is a recipe for failure. By focusing all your attention on one ticker, you have turned your financial life into a battlefield, where every tick of the chart is a personal attack. You are not observing a business. You are engaging in a war against a screen. When you isolate a single stock, you lose the ability to see the broader picture. You begin to define your success based on the volatility of one entity, ignoring the fact that the market is designed to fluctuate. This tunnel vision creates a feedback loop of anxiety. You check the price, you see red, you feel a drop in your own confidence. You check the price, you see green, you feel a temporary sense of relief. You are essentially handing over your emotional stability to a machine. This is not a strategy. This is a self-imposed prison. You have narrowed your world to a single point of failure. It is time to step back and recognize that your current approach is fundamentally broken. Successful investors do not fight the market. They build a balanced engine. They pair the explosive growth of a giant like TSMC with the steady, reliable pull of diversified ETFs or dividend-focused assets. Think of your portfolio like an aircraft. If you have only one engine, a single bit of turbulence feels like a catastrophic crash. You panic because your entire lift depends on one point of failure. But when you have a balanced portfolio, that same turbulence is just a normal part of the flight. The dividend yield provides the lift, while the broad market index provides the stability to keep you level. You stop looking at one stock in isolation because your total net worth is no longer tethered to a single ticker's daily mood swings. You are not trying to win a fight. You are building a system that absorbs shocks. When one sector dips, another holds the line. This is the difference between gambling on a single outcome and engineering a path to wealth that survives the inevitable storms. You need to stop viewing your holdings as individual soldiers in a war and start viewing them as components of a machine. Start looking at your total net worth growth instead of the daily red flashes on your screen. Build the engine that lets you keep flying while everyone else is busy crashing. Investing is not a sprint to see who buys in first. It is a marathon to see who can hold on the longest. If your current holdings keep you awake at night, your strategy is actively fighting your biology. You are trying to force a short-term win out of a long-term game, and your body is sounding the alarm. That knot in your stomach, that is the physical cost of a broken strategy. You are wired to react to immediate threats, but the market rewards those who stay the course. Real wealth is not built in a single quarter. It is forged through cycles of growth and correction that span decades. If you cannot sustain your buys during a 2-year bear market, you are not investing. You are just gambling in slow motion. It is time to stop pretending that your current panic is just part of the process. It is a signal that your approach is fundamentally misaligned. Look at your portfolio. Does it allow you to sleep? If you are fighting your own biology, you have already lost. Take the time to recalibrate. Now that you have identified the traps, it is time to put your logic to the test. You cannot fix what you refuse to measure. I want to see where you stand. Leave a comment below with your average cost on your primary holdings, or describe the core strategy you are currently using to manage your risk. Do not worry about the numbers being perfect. The goal is to expose the logic behind your choices so we can break them down together. When you write it out, you force yourself to confront the reality of your position rather than the fantasy of your hopes. We will look at these strategies, identify the remaining blind spots, and determine if your current path is actually leading you toward your goals or just keeping you trapped in a cycle of reactive trading. This is not about judgment. It is about building a community of investors who prioritize discipline over emotion. If you are ready to stop guessing and start executing with precision, join the conversation. Subscribe to this channel, hit the notification bell, and stay tuned for the next deep dive where we will audit these strategies in real time. The market will always provide opportunities, but only those with a clear, audited, and resilient plan will be there to capture them. I will see you in the next video.